today, we wanted Paul to discuss mortgage programs for investors, as well as down payment requirements and how to calculate that rental income in the approval process. Paul, great topic. Thanks for being here.
Investing right now, a lot of people out there, investors, are looking to buy properties, and there's different ways to get financing, of course, but the traditional way I would say most investors are aware of is conventional financing. I mean, it's a great program. It's traditional 30-year fixed rate typically. With that program, they look at a situation where 20% down on a single family investment property is kind of the industry norm. If you're looking at a 2 to 4 unit, which most investors are looking at the multifamily properties because they bring in more cash flow, 2 to 4 unit require anywhere between 25 and 30%, depending on credit score and debt to income ratio. So keep in mind, most investors are very shrewd. They want to, maximize their return, also minimize out-of-pocket cost and down payment. So conventional is great for people, high credit scores that have a lot of money, at their disposal. Rates are a little bit lower traditionally because it's conventional, but they also look at, with conventional financing, you have to qualify. When I say qualify, what do I mean by that? Well, the numbers have to be within certain parameters. Debt to income ratio, which is something you hear all the time. With investment properties, you have to be under 50, ideally 45% DTI. Now, what does that mean? Well, a lot of investors who show, who own rental properties have, on their tax returns, it's called the Schedule E. They show their rental income. Now, most people who have numerous investment properties have a tendency to have expenses, write-offs. So when they look at their rental income, sure, it looks good, like they're making money each month, but then after their expenses, they're not showing a lot in the bottom line. So because of that, even though they have these properties, they normally don't qualify for conventional because the numbers don't work on traditional, financing. So, okay, so most people, I would say 2/3 of investors fall in that bucket. So with that being said, what do we have for people that maybe, are great clients, have good credit, but maybe the income on paper isn't always consistent with what we need to qualify? Well, we have a program, it's called the Investor Cash Flow Loan. And I do the investor cash flow all the time, actually doing 2 as we speak. And this program is geared toward investors. Obviously the property, what they look at is, what is the return on investment? What is the rental income each month? So for example, with this program, if you're a repeat investor now, let's just say you have a property already, you want to buy a new 3 or 4 unit. We'll look at, okay, what's fair market rent? Let's just make this easy for math. Let's say fair market rent is $2,000 per unit. You want to buy a 3-unit property, say in Providence. Yeah. So 3 units at $2,000 per unit, that's $6,000 a month essentially is what we expect you to make on that property. Now, if you can put down at least 20%, you only need a 600 credit score with our program, which is very, very attractive to some people. As long as the new mortgage, principal, interest, taxes, and insurance is less than what the rents will be, you qualify. So think about that. You want to buy a property in Providence. I use, for example, rents are $6,000 a month. Say the property is, $600,000, for example. Let's say the mortgage comes to $4,500 a month. You qualify. You just have to have the credit score and the 20% down. And then we look at how we calculate rental income. This is important. With this program, obviously, if there's lease agreements in place, we're going to go by lease agreements. But if there's a month-to-month situation, or if it's something where the property, no one's living there, we'll go by fair market rent that the appraiser determines. And keep in mind, what we can do, if we can provide them with comps for higher rents, we can give the appraiser a good idea of what rent should be at. So essentially, it's a no-doc loan where you can use rental income and 20% down to qualify for a mortgage. No tax returns, no pay stubs, no W-2s. I mean, you're an investor who's very busy, who wants to get this done in a timely manner. Beyond hard money, there's not much else that's any easier than this. A couple other things I want to mention. One is you can purchase this property in an LLC versus individual. So a lot of people like that idea. You're a business person. Oh, you know what? I want to buy it in my LLC versus in my own name. And so that's something else that we can do with this program. And then 2 other things I want to mention as well. So let's say, for example, you have a situation where you want to buy this property. You're maybe you have money in the bank, but maybe some of the money is not liquid, or maybe that, you're like, I have about 15%. What can I do? Certain situations, they'll allow you to get gift funds from family members. Most investment programs, you have to have the money yourself. So gift funds are an option for your down payment. And then one other thing I wanted to mention was, if you can put down 30%, and again, I know it's more than the 20% we require. If a situation arises where you love the property, but let's say, for example, there is a situation where there's old tenants in there who are paying lesser rent. Let's just say they've been there for 10 years and the rents are really low. And because of that, on paper, the numbers don't work, meaning, the rents combined aren't more than what the mortgage will be. If you put down 30%, will actually allow you to buy the property and get only 75% of what the mortgage will be from your rents. And will actually allow that to happen even less than what, the actual mortgage will be, in that case with 30% down.